Hello everyone, this is Brian Rezny, President of Rezny Wealth Management. We've got a great show for you today. We're going to talk a lot about not only the economy but the investment markets, and we will be taking your calls live. At the bottom of the screen, we're lining up calls right now. Call the studio, give your question to one of the studio producers, and we'll take your question and answer it while you sit back on that couch. You could also send me an email question at brianrezny@reznywealth.com, and I'll answer your question, of course, on the TV as well. One of the things that I want to discuss a lot today is, as we see the economy slowly getting better in the U.S., we're seeing a lot of things happening also in Europe, and we're seeing a lot of things for improvements over in the emerging market economies, namely China with a big announcement in the last week or so about major reforms to help increase their gross domestic product. I think right now what investors have to realize is this. While we've seen spectacular gains in some of the markets overall, these gains may continue for many, many, many more years. Unfortunately, I think the vast majority of investors are not actually realizing any of these gains because, number one, they're in the wrong place. Number two, their investment strategy is not adaptive to changing market conditions, and we're going to talk more about that today. Of course, your questions are welcome, and I'm going to go to my first question right now. Sam in Fort Myers, Florida, I have an account with a major brokerage firm. We pay commissions for the funds we buy. Is our advisor really watching our money? Absolutely not. When you have a brokerage account, not an advisory account, an investment advisory account, and unfortunately most people falsely believe their broker, who might use a fancy title of advisor, when you're in a brokerage account, you are responsible. You are responsible to manage your own money. You are responsible. I want to stress that. Sam, at the end of the day, your broker might be a nice person. Their job is sales, though. In a brokerage account, your broker calls you once a quarter with the warm and fuzzy, what we call relationship call. But at the end of the day, he is not obligated to actually call you about making important changes. About the only time you're going to hear from most of these brokers or advisors is when they want to sell you something new or to keep your money in what you already have it in so they continue to get their trails and their commissions on the products you're already in. That's not money management. So again, when you have a brokerage account, not an investment advisor account, you are fully responsible, not only to do your own research, what the broker's doing is giving you recommendations based upon what you're suitable to buy if you're a growth investor or income investor, as an example. It's your duty after that person shows you those investments to do your own work. Do not trust that brokerage firm's recommendations without doing your own homework. Their obligation is to themselves and their firm. You are second fiddle. So again, investment advisory account, that's managed money. Brokerage account, which I would say about 90% of investors have, that is not managed money. That's complete sales, and that's where the conflicts of Wall Street are the full reign. About 90% of the new accounts that hire our firm every month at Rezny Wealth Management falsely believed that their money was actually being watched and managed. And when we explained to them that they actually have a brokerage account, not an investment advisor account, they were somewhat shocked. They also realized why often the broker always told them to hold on and wait for things to come back. Remember, your broker wants to keep you always invested, and sometimes being invested is not where you should be. Tony in Fort Myers, Florida. Our advisor is recommending a Pacific Life Value Select variable annuity for our 401k plan rollover. What do you think? Tony, absolutely not. I had a call similar to that on that exact same product about 2 weeks ago on my radio show. Pacific Life has a number of annuities. That particular one, that Value Select, don't touch it. In fact, never ever put your 401k plan money or IRAs or Roth accounts in an annuity, any kind of annuity. That is just stupid, bad advice by your broker who wants to sell you something that's going to line his pockets more than yours. Annuities are toxic. The internal cost ratio on most of these products are incredible. In fact, the product you're talking about, depending what options you pick, depending what sub-accounts you invest in, you could be well north of 3.5% to 4.5% on the low side of annual expenses against your money. The investment options they have are kind of mediocre and limited. So you have high expenses, mediocre to limited investments, and again, remember, You have to pick these investments, Tony, because again, you're working with a broker who's selling an annuity. By the way, your broker's working under suitability. His firm and his interests are different than yours. He's clearly not a fee-only money management firm who's working in a fiduciary capacity, meaning he has a legal obligation to work in your best interest. You clearly have a salesman who wants to sell you an expensive annuity to line his commission-ridden pockets instead of what's best for your retirement portfolio. Tony, I would recommend you give us a call. We have offices in Fort Myers and in Naples. Call us. We don't sell annuities. In fact, I believe they're toxic to your retirement. Call us for a consultation. Let's sit down. We'll show you how real investment management works that is in a low-cost structure that can benefit you. And an important part of our money management is risk management, which you're clearly not going to get from Mr. Broker. Lou in Bonita Springs, Florida. What do you think about non-publicly traded REITs? Lou, kind of like my last caller, Tony, never ever buy a non-publicly traded REIT. Non-publicly traded REITs, again, are sold by brokers who work under suitability. You could buy a publicly traded REIT through an ETF or an exchange-traded fund. That's 100% liquid, transparent. You can buy it today, sell it tomorrow, keep it for as long as you want. You have liquidity. Also, the cost structure of an ETF that would own these REITs are substantially less expensive than a non-publicly traded REIT. When you buy a non-publicly traded REIT, the only reason brokers sell these again is because of the lavish commissions that they basically line their pockets with. Please do not buy a non-publicly traded REIT. These things, again, are expensive, and those high expenses, often as high as 3 to 4% every year, not to mention the underwriting costs when you buy these things. We see markups or takeaways from your initial capital often as high as 18% off your original money. So again, you can get all the benefits of a non-publicly traded REIT without the hideous cost and the lockup by looking at publicly traded REITs. Your broker doesn't want to show you a publicly traded REIT because they don't make much commission when they show you or sell you one of those, but they make a whole boatload on non-publicly traded REITs. The question you have to ask your broker is, if I decide I want to sell this in a year, or if the investment goes south, how do we get out? You can't, and that's the problem with those investments. William in Naples, Florida. I heard your show last week on relative strength investing. Can you explain how that works? That's a great question, William. You know, we talk about relative strength and relative weakness a lot. And one of the things that I encourage every investor to understand is this. Assets or investments, whether it's the stock market, the bond market, real estate, gold, whatever asset category it is, investment assets tend to be relatively stronger in an uptrend, or they tend to be relatively weak in going in a downtrend. At the end of the day, you, the investor, have to realize this. If you have an asset that is relatively weak and trending down, that's going to take away from your return. Statistically speaking, and a lot of research has gone into this, relatively stronger assets have outperformed, relatively weak assets have underperformed. In fact, I'd like to show this picture, and I usually get a laugh out of it. You want to own the racehorse, not the mule. What you want to do as an investor is you want to own relative strength, and you want to sell assets that are coming off relative strength and starting to roll over and become relatively weak. One of the categories, and I've talked about this a lot throughout all of 2013, is gold. We actually at one time at the end of 2012 owned the GLD, which is an ETF that owns physical gold. It was in our ranking system in our portfolio back in December of 2012. Gold started to get weak and started to roll back over, and it fell out of our top ranking system. Because how we manage money, not only to make a return, but also control risk, gold was sold because it started getting weak. Guess what? Gold is down over 24% year to date since we sold it in December. And one of the positions that we own right now that replaced gold was the IJH, or the iShares Mid-Cap 400 in the U.S. That's up almost 30% year to date. Now, past performance isn't indicative of future results, but what I want to stress is this. You want to buy into relative strength. You want to sell assets that are becoming relatively weak. Don't ride the roller coaster all the way to the bottom. And one of the problems that too many investors face is they don't know what to buy. So what they do is they buy a bunch of assets, they hold them in the portfolio, even when they're not appropriate. Let's bring it all together. You've got a stable of investments. These not only would represent stocks, bonds, gold, commodity-based, all kinds of asset categories. You want to basically buy a group of assets that are relatively strong. I usually recommend about 5 investment main sectors at a time. And what you want to do is you want to track those. And as long as those horses stay relatively strong, you want to own those. If one starts to become weak and one runs up into the ranking system, what essentially we do is we sell that and replace it and try to keep the portfolio relatively strong and in that uptrend. Again, asset categories can be relatively strong for many, many, many years, and they can also be relatively weak, like we're seeing in gold now, for many, many, many years. Buy in the strength, which ranks the performance of that asset category over given periods of time, and replace strength for weakness. We'll be right back. We're going to take a short break. We'll take more of your calls after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Do you know the biggest risk to your retirement and investments? One is entrusting your hard-earned money to someone who doesn't work in your best interest. The other is a lack of a detailed investment strategy to meet your goals. Both risks can be devastating, but both can be corrected. Rezny Wealth Management, fee-only money management. Don't settle for questionable investment advice. Call my firm for a consultation. There is a difference. Hello everyone, we're back and we're talking a lot about the economy and the investment markets. Of course, we are taking your calls today, so the number's on the bottom of the screen. One of the things that I want to talk a little bit about today is really what's going on in our economy in the U.S. and more importantly, what you're currently doing with your money. I think too often, too many investors don't look at the big picture, and I think too often investors get complacent with their overall portfolio. And what I mean by that is kind of like a garage. We all have one, and over time you gather a lot of items in the garage, and one day you look in the garage and there's all this stuff stacked up that you hardly ever use. Unfortunately, we see this often with new clients that hire our firm. The portfolio resembles basically a garage. A lot of assets they're not sure if they should own. They were sold different things from the brokerage firm or the insurance guy. And basically it's a clutter of garbage, and it's not accomplishing your real goal, which is ultimately to make you a return on your money with also measured risk. And again, take a look at your portfolio. Is it started to become overloaded with too many different mutual funds, stocks, annuities, and bonds? Is it working the way that you intended to work? And what is the strategy around this money that you actually have? One of the things that investors need to realize is without a detailed investment strategy, which not only includes what to buy or when to buy, how does that factor into the portfolio? But I think the most important thing that people miss out on is when to sell. There are times in the economy, whether it's now or 5 years from now, we may go into recession. There's going to be times with your strategy, and if you have a strategy, it should include when do you sell, as an example, equities, in order to avoid catastrophic losses in the next big market meltdown or the next recession. Is your portfolio starting to resemble a garage? Or do you have a detailed strategy that helps you move around fluidly and sell assets when they're appropriately to be sold? Carl in Cape Coral, Florida. I own the Hatteras Futures Fund, APHAX, and heard your show about managed futures. Would you sell this? Carl, I sure would. In fact, we've received a number of calls on my radio show in the last couple weeks. Bloomberg wrote a great article, and it's entitled How Investors Lose 89%. It was an excellent article written by Bloomberg. You can actually see the article if you visit my website, reznywealth.com, click on the resource tab, and go right to the Rezny Wealth Report archives. You can read the article there. It's excellent. A lot of these futures funds, the Hatteras fund is no different. These things typically carry immense eternal expense ratios that basically take away from your return. That Hatteras fund, I had a call similar on that same fund about a week or two ago, and I looked it up and did a lot of research. That particular fund has an annual expense ratio of 4% based upon Morningstar. If I look at the last 1 year, 3 years, and 5 years of that Hatteras fund, the track record is completely lousy. At the end of the day, fund expenses are eating away not only your return, but the way they're managing that money just isn't working. You need to sell that fund and get out. A lot of the brokerage firms are convincing their client to buy what's called alternative investments. So if you've had your broker use the word alternative investments, that's often one of these future funds. You have to realize when expenses start to get much north of 1.5%, you're really hitting your portfolio hard on the return that you should be making. If I look at that Bloomberg article, they cited a number of different futures funds that a lot of investors invested in, and how at the end of the day, the fund that's themselves made return, but the expenses were more often than the actual returns they made, so investors made no money and often lost monies on these. This particular fund you own has just really has a poor track record, and I would absolutely sell this immediately. If you're an investor like our last caller and you own one of these alternative investments, you should seriously also look at your statements and see, does that belong in your portfolio? Is that good for your portfolio, or is it better for the broker who sold it to you? In fact, one of the futures funds that was cited in the Bloomberg article has an annual kickback to the broker of over 4%. So you can understand why brokers want you to hang on to this stuff. They get these huge kickbacks, these conflicts, these incentives to keep you in these lousy investments. That doesn't help your portfolio, and it doesn't help your retirement either. How investors lose 89% of the gain. Go to my website, reznywealth.com. You can download that article for free. And again, if you own a futures fund or one of these alternative funds, that article is a must-read for the safety and security of your retirement portfolio. Linda in Fort Myers, Florida. My husband and I each have a Roth IRA and trust accounts. Our advisor has all of our money, it looks like, in variable annuities through Pacific Life. You have repeatedly warned about variable annuities. Why are we in all annuities, and can we get out? Why are you all in annuities? Well, I'm going to guess it's because of the commission the broker sold. First off, a Roth account grows tax-free. Why would he put your money into a variable annuity from a Roth? That makes 0 sense whatsoever. I had a call earlier on Pacific Life. I seem to be getting a lot of these calls, not only on Pacific Life. Don't think that's the only poster child for variable annuities. There's a lot of variable annuities, and they all run very similar expense ratios, so you have to read that 150, 200-page prospectus. Bottom line, your Roths do not belong in an annuity, whether it's a variable or any other annuity product. That makes 0 sense. The costs are going to rob your returns. Your trust accounts being in annuities again, why just Pacific Life? Why not ETFs, exchange-traded funds, at a fraction of the cost structure than a variable annuity? What I believe you have is you have a broker who wants to basically make his next car payment or boat payment, and unfortunately you're getting a lot of bad conflicted advice. I would seriously call our office for a consultation. I would love to sit down with you and your husband. We can go through and see if we can get you out of these annuities with the least amount of harm. That would be the best solution that I can tell you at this point. You could visit our website, reznywealth.com. We also have a free report only available on our website. It's called Why Annuities Are Dangerous to Your Wealth and Retirement. Go there right now. You can download the report for free. It is a must-read for anybody who's been sold an annuity and you're regretting it at this point in time. Tim in Naples, Florida. I own 24 mutual funds, all in American funds and Fidelity funds, and a Fidelity variable annuity. We have done poorly and the markets are doing well. Help. Well, first off, I don't understand why you own 24 mutual funds. That's clearly too many funds. Why you also own only funds in American funds and Fidelity funds. I can firmly tell you American funds and Fidelity funds do not have the best or the cheapest mutual funds, and all of your funds are basically in those two fund families. Why not less expensive ETFs, exchange traded funds? I can tell you why. You clearly, again, are inside a brokerage account. Your broker wants to sell you the funds that his firm or her firm sponsors and sells, and that's a big conflict of interest. And 24 funds is a little crazy. I want to pull up a chart, and I talked about this last week. Asset allocation, I call it the failed pie. This resembles your portfolio. What you have is you have 24 mutual funds in your portfolio. We also don't know how many sub-accounts you're invested in that variable annuity. That could be another 10 or 15. So what I'm trying to say is this. You own all these asset categories, my guess is that are all overlapping each other. They're kind of the same thing. A lot of expenses. You own good assets, maybe, with a lot of poor assets, which does what to your return? It waters it down or brings it down. If the markets are doing well and your portfolio is doing poorly, that should tell you something about all the stuff you're in. Again, I don't know if you're in stock-related mutual funds or bond-related mutual funds, but I can tell you this. Whether you had $500,000 or you've got $5 million, once you get past 5 to 6 diversified ETFs that own a basket of securities in 5 different sectors, you really don't get a lot of benefit of diversification. What really happens is you're adding assets at that point that aren't all that strong and are actually could be relatively weak, and it starts dragging down the possible returns from better asset selection. So what you're probably seeing is you've got a lot of good stuff, bad stuff. It's basically bringing everything down and you're not really making any money. Yes, the markets are doing well, but you may be in exactly the wrong place in your failed asset allocation pie. Again, I'd encourage you to call our office for a consultation. We do have offices in Naples and Fort Myers. I'd love to sit down. I'd like to see how you're really allocated out. I'd also like to see which particular American funds and Fidelity funds you're in. And I definitely want to review that variable annuity because, again, why do you own a variable annuity in the first place? It probably doesn't belong in your portfolio, and we can tell you exactly what that annuity is costing you and how it's impacting not only your returns, but also the absorbent cost structure that comes with it. Arnold in Fort Myers, Florida. My advisor recommended we buy gold and commodity mutual funds 2 years ago as part of our asset allocation. Both have done poorly. What would you do? Arnold, that's a great question. First off, and I've talked about this repeatedly all through 2013. In fact, I wrote an article on our website. If you go to our resources tab and click on there, you can find the article in our Rezny Wealth Report newsletter archives. And basically, I talked about relative weakness. And I've talked about that throughout today's show, by the way. Gold and commodity-based assets have been relatively weak basically for years. So ultimately, what's happening is you own assets that are basically in this negative downtrend, and you keep owning them. What's probably going to happen, I want to hit gold more so than even commodities, but they're both weak, and they're both generally down year to date. But let's talk about gold. We sold our gold position back in December of 2012, so basically well over 10 months ago. Since we sold our gold position, gold's down over 24%. You obviously have to be down the same amount, and if you own mutual funds, you might own gold mining shares, which isn't physical gold, and you could be down a lot more than that. In fact, the gold ETF that owns mining shares, that's down between 40 and 50%. So that's obviously a horrific problem. But we're getting into the year end. Typically what happens is this. Asset categories that have been fairly weak throughout the year and have shown losses, investors start to do tax loss selling as we get into the month of November and December, which often pushes these things down even further. So my guess is that you may see even further losses in commodity-based mutual funds and gold because of this weakness and the selling pressure that often happens as we get into year end. I would suggest you sell these mutual funds immediately, basically take your tax loss and move on. Remember this, relatively weak assets tend to underperform. Relatively stronger assets in an uptrend historically have outperformed, again, over various time frames. You want to sell relative weakness before it drops 25, 30%, and you want to replace that with assets that are rising properly and are relatively strong. If you want to learn more about relative strength and relative weakness, you can visit my website, reznywealth.com, and click on our investment strategy tab. We talk more about how we manage money, how our strategy is adaptive versus a buy and hold. What it sounds like, again, you've bought a couple mutual funds, and what I'm fearing is you could be down a lot more than 24% like gold is year to date. Most of these mutual funds don't just buy physical gold, they buy gold mining stocks, which a lot of these are down 40, 50, 60% year to date. And don't think just because something's down it's going to turn around and get right back up. In fact, based upon our low inflationary environment, the government obviously has already indicated at some point they're going to start taking away our quantitative easing and rates will slowly move up. Gold is still going down. So at the end of the day, unless you have massive inflation, which we are not seeing in the sites at all, gold will probably keep trending lower and lower and lower, and you've got a chance for a lot more losses within your portfolio. I always love getting your calls and your questions. If you'd like, you can send me additional questions to Brian Rezny at reznywealth.com, and we will read and answer those questions on the next show. I'm also encouraging all of our listeners today, please visit my website. Go to reznywealth.com. We've got the address at the bottom of your screen. We also have a free report for all of our TV listeners. It's called How to Avoid Outliving Your Money During Retirement. We also have a hard-hitting report for all you people who were sold annuities. Why annuities are dangerous to your wealth in retirement. Both reports are free. You can go right to my website now and you can download those. The address is at the bottom of the page. I want to leave you with this. If you're concerned about the lack of management you're getting in your portfolio, if you're realizing you're not achieving your retirement goals, or maybe you're realizing the person you entrusted with your money is maybe not really actually managing your money at all, and you're realizing it's time for that important change, I encourage you to call our office for a consultation. Rezny Wealth Management is a fee-only money management firm. We don't sell investments, we manage portfolios, and there's a big difference. An important part of our investment management process is risk management, or when is it time to sell. I cited gold earlier and why we sold gold, and believe me, our clients are glad that we sold gold when we did. Not only do you have to know when to buy an asset, you have to know when to sell and reduce risk in your portfolio. Call our office right now. The number is going to be at the bottom of your screen, or visit our website, reznywealth.com. We do have offices in Naples and in Fort Myers. Make sure you have yourself a safe and profitable day.